You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music can mean only one thing. It is hashtag Education Wednesday here on the network. Time for Options Bootcamp. Actually, a little bit of surprise early dose of Education Wednesday. If you're listening live, you're getting it on a pre-Education Wednesday, Education Tuesday. It's a little bit of an early gift for all you Options Bootcamp lovers out there. You're listening after the fact. You're just going to hit play on your device, and you won't notice a thing. Either way, you're still getting the great same content you folks have come to know and love here on Options Book. Remember, if you know it and you love it, keep rating it and reviewing it so other folks can get to know it and get to love it there as well. Keep those questions and comments coming as well. We do love to hear from all of you guys and gals out there. Let's see who we're hearing from on the old program today. Let's go out to the sleepy hamlet of Frankfort, Illinois, where we are joined once again by the black-hatted one himself, Mr. Dan Passarelli, the founder and CEO over there at Market Taker Mentoring, also the author of one or two or maybe six options-oriented tomes. Mr. P, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir.
Oh, I love being here, Mark, and I love chatting with our audience.
I do as well. Lots of good questions, but before we get to their questions, Mr. P, I think we should do a little bit of the old options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, welcome to the options drills section of the show, the portion of the show we break down an options topic or technique and get a little bit more into detail about how it works, or maybe sometimes it's a theoretical discussion you guys have with us, and we want to hash it out for you here on the program. Before we get to that really quickly, Dan, it's been yet another topsy-turvy period here in the markets. We're actually seeing now for really the first sustained time, we saw a few flirtations below the 20 handle over the course of the past month and change. But now really since the beginning of the pandemic, this is the first time we're seeing VIX really having a sustained move below the 20 handle at around 18, actually flirted with some 17 handles out there in the marketplace of late. And like actually right now we're at a 17 handle, just broke through the 18 handle, 1792. So once again, at a 17 handle, Mr. P, we haven't seen this since before the onset of the pandemic. Of course, a lot going on. S&P, everyone was watching that magical, mythical level of 4,000. Could it break through it? Could it maintain it? It flirted with it a few times, and then it broke through it and kind of hasn't really looked back. So a lot to unpack from a market and a volatility perspective. What's been lighting up your tape and the tape of your clients over there at MTM since we last chatted, sir?
Yeah, Mark, I always like to talk sort of nice and broad and general so everybody gets the concepts here, because this is boot camp after all. So let's start definitely with the broad market. So there's a whole bunch of positive things going for the broad market, and with the VIX so low, being at all-time high in the S&P 500 today, I always think it's a good time to hedge. Now, I want to be very clear. I'm not calling a market top. Nobody calls a market top. I think Elaine Garzarelli back in 1987 is the last person who called it.
She dined out on that for decades afterwards.
Yeah. So, and look, like anytime anybody says, hey, now's a good time to hedge, like they're only saying that when everything is rosy. Like you can't time it that way, in my opinion. So I'm definitely not saying, oh, this market's super overbought, it's going to fall or anything like that. But what I am saying is, hey, you made some pretty good dough probably over the last, since the bottom out in the pandemic. If you played it nice, you can buy really relatively cheap options, at least for the past 12 months. And so I've been just picking my spots, slowly scaling in here or there into some puts. I probably won't end up being fully hedged. In fact, for sure, that my plan is not to be fully hedged, but just to pick up some cheap puts if and when I can, just to protect myself. But overall, there's great stuff going on with the market. The government is just going to hemorrhage a whole bunch of more money, drop it out of airplanes, basically, to anybody who wants it, building roads. And whether you think that's a sound economic idea or a terrible economic idea, when there's a whole bunch of money dumped into the economy, it boosts the economy, at least in the short term. We can argue about long term for sure. And so all that stuff is good for the stock market. What else? Interest rates seem to not be too crazy heading higher. I haven't been watching bonds too much lately, but, I feel like they've stabilized somewhat, at least definitely not a whole bunch of fear for rates going too much higher today. Could change tomorrow for sure. So, yeah. I'm going to go with the cautiously optimistic stance.
That isn't very black-hatted of you at all, sir. I expected dire pessimism. Run for the exits right now. Hedge quickly. But apparently he's being more level-headed on the show today, Liz. We'll see if we can fix that throughout the course of the show. But now it's time for our options drills. This was actually inspired by a listener question, a bit of a timely topic. This question came in from Big Time Bob. I like that handle. He's big. He's big time. Says, hello, options dudes. I like Bob already. He's cracking me up. Bob says, looking to cut my teeth on these options things. Just wondering how much I should reasonably be expecting to trade. Is 5 options, easy for me to say, is 5 options positions too many for a noob options trader? He's a noob. Okay. 10, should I just start with 1 position and let it grow from there? Dan, I'm sure we have many listeners in a similar boat here to Big Time Bob. They kind of discovered options for the first time over the course of the past few months or the past year. They've been maybe thinking about dipping their toes in. Maybe they already have a little bit, and they're wondering if they're doing it right. And usually that starts with this whole position question. As it just so happens, Mr. Bob, I do believe, Mr. P, you folks over there at MTM just put out a whole recent rash of content about this exact topic, about how many positions you should have as a beginner options trader. So I shall cede the floor to you there, Mr. P. What do you have to say here for Big Time Bob and everyone else out there in the audience who's wondering, they're kind of getting started in these options things, how much should they be trading at the beginning?
So I have a very decisive answer on this one.
6. The answer is 6. Isn't that what you're going to say?
The answer 6. Okay, let's move on. Next question. No, Bob, if you have not traded a single option yet, you should start with one position. And I would argue that it should probably be a one lot, just because, the first time you do anything, the first couple of times you do anything, you're going to screw something up. Everybody does, right? So even if you have a $10 million account, let's just do a one lot. You dip that toe in the water and see what it's like first. Make your mistakes with a teeny bit of money. And then once you have confidence and competence, ratchet it up to your normal size. But once you've put on a trade, went through the life cycle of the trade, took it off for better or for worse. So once you get a couple of, trades under your belt, single trades that you go through the whole life cycle of the trade, put it on, live it out, take it off. Then I love the idea of moving on to putting on 2 trades and then up to 3 trades. Now, don't rush into it where you're like, dude, I still don't know what I'm doing, but let's throw on 3 trades. Wait until you feel a little bit comfortable. It'll take you years and years. If you're doing it right, it should take you the rest of your life of constantly feeling more comfortable. You get better at anything the more you do it, right? But when you have on only one trade, here's what happens. You can very easily get emotionally invested in it. You can very easily be like, oh my God, is this stack? Oh, wait, it ticked up 3 cents. Oh no, wait, this is a short delta trade. Oh no, what am I going to do? I better take this up. And, you whipsaw yourself. Or like, oh my God, look, this is my first trade. I have a profit. I made $7. I'm just going to take it. Like, you can way overthink it and get way emotionally invested. So I like, as soon as you're reasonably ready to move on to 2 or at most 3 trades, and live that out until you get pretty comfortable. And then it's as many as you can handle. I used to talk to this one student who came to us. He signed up for one-on-one coaching, and he was making like hundreds of trades a day, and he had on like 50 different positions, and he couldn't figure out why I was losing money. He's like, yeah, I'm down like, I forget what it was, like $400,000 this year. I was like, why are you down $400,000? Let's see your account. And he's making 200 trades a day. He had on, 50 or 100 different names. And there's no possible way any human can manage that. Some professional trading firms have technology, like multi-million-dollar technology that's built and programmed that enable them to manage that many positions, but no single human can watch 50 different positions. Like, you can't. So, ratchet it up. I would say, after you get through that 2 or 3 for like 6 months or a year, you can get up to 5, you can get up to 10. I think once you start getting above 15 different positions, it should take you a few years to build up to that. That's a lot to watch. It's a lot to pay attention to. And if one trade slips through the cracks, it can mess up your day. It can erase 18 winners. So don't bite off more than you can chew. That's basically the whole paradigm for how to do it right, in my opinion. And I think if you do it that way, you're going to be in good shape.
Yeah, I concur with that pretty much. I think starting off, you can't go wrong with a one lot to really get the ball rolling. People definitely get too deep into the deep end of the pool too quickly out there. I've seen many people like you have, Dan, that come in. You're right. They have dozens of positions. People send us this email all the time, this question of, hey, what's wrong with this trade? And you could see they sent us this, litany of trades, and you can see it started off with maybe a very basic very concise idea, very concise strategy, very limited type size. And then they start adding to it and amending to it. And next thing you know is this weird Franken monstrosity that has dozens of legs and doesn't make any sense anymore. And that's kind of an analogy for your beginning trading as well. Start off with a very clear, concise, measurable outcome, measurable goal, something you understand, something you can achieve very readily with a small options position. This brings up an interesting kind of corollary to this question too, Dan, which is something we've touched on in the past, but might be interesting to revisit now as well, which is, in the past, people have asked me a million times what my favorite starter options position is, what they should really use as their first options trade. And for me, the gold standard still is that your very basic covered call, because most people come to the options market having already traded stock. So they're used to stock. They probably have some stock positions on when they're thinking about trading options for the first time. So it's a very, very intuitive thing for people who have been used to buying and selling stock to now say, hey, I have, let's say, Ford in my account right now. I'll sell it if it gets to 15. Let me see if I could sell a covered call on Ford at this level, and just do it one lot if you got 100 shares. It's a very simple, very straightforward type approach. People understand that they can wrap their heads around it. And it's also a way that's additive for them. It's a way to get a little bit of an income stream on a position they otherwise would maybe just be sitting there. So it's an additive thing, and it's also intuitive and easy for them to understand. Of course, Dan, over the course of the past year, we've seen a lot of newcomers entering the marketplace, and the majority of them were diving headlong into upside calls, and they were buying out of the money calls. And that's the way I've kind of cautioned people in the past. Maybe you don't go that route because it's more difficult than you might think. But I'm curious for you, as we stand here now, 2021 pandemic, hopefully the teeth of it behind us, and this new wave of people having hit the options market. And people are, I'm sure, asking this question all the time at MTM. Where do you stand now? What is your go-to recommended first options kind of starter trade, sir?
I've thought about this a lot, and the answer is going to have to be it depends on your motivation if you want to use options as a trader or an investor. And a lot of people do both. I do both for sure. But covered calls are a very, very natural trade if you fall into that boat that Mark was just describing, where, you've invested in stock, and I'm going to use the word invested specifically. You've invested in stocks for many years. You've gotten good at that. You want to use options to help lower your risk as well as generate greater returns. Covered calls, one that, you can start with covered calls and never trade anything else if you're just purely investor mindset. But, if you have a smaller account and you want to do more trading as opposed to investing, things like buying calls are a very, very natural thing to do too, because, people think about stocks going up. They approach the market with that context, like, hey, if I like this trade, that means I think the stock is going to go up. Everything else is just implied behind that one bit of logic. Now, as we've said many times on the show before, buying calls is a tough way to make money in the long run. Spreads is typically better, but calls are easy to understand. Start with those.
Yeah, it's funny. I can't remember really anyone coming to me saying, hey, I started my options trading career by buying a put. It's just a counterintuitive thing for most people to be able to wrap their heads around buying something that makes money if a stock goes down. They can't get there to start off. So it's usually either selling a covered call or probably the flip side of that, buying a call. I got to say, that's 90% of the people who come to us with their starter options positions. That's how they start. How did you start in the options market? Hit us up. Let us know. We're curious to hear from you. I have a feeling if you started in the past year, you probably bought some calls, but if it's something different, or maybe you like the buying call approach for people, I think that's a good starter way because they can wrap their head around something that's effectively a bullish long delta type stock, effectively equivalent position anyway. So hit us up. Let us know what you think would be good for a new options trader as we keep on rolling. Speaking of hitting us up, let's get some of you on the show here. A little bit of your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call, the portion of the show where you folks take the reins, your questions, your comments, your pearls of wisdom. By the way, if you want to play in our Options Broker Madness tournament, or perhaps you've already played in round one, you got in there on the Sweet 16, you played again, you voted again, you registered to win fabulous prizes again on the Elite Eight. Well, guess what? We're down now to the Final Four, which means you have another opportunity, fellow listeners out there, beloved listeners, to play yet again, to vote yet again, and to also win fabulous prizes. Register and win every round, or I should say register to win every round. And then at the end, you have many more opportunities than the guy who just voted one round only. You can only vote once per round, but you can vote every round. So get out there now. It's quite the tourney we have going on here, Mr. Dan, as the Leviathan of Schwab/TD Ameritrade continues to just steamroll everyone in its path. It wiped out Tradier in the first round. Then it took on a bit of a fan favorite out there in Tasty Works and blew the doors off them to get into the Final Four. They're coming up against a bit of an upstart. Also ran Lightspeed, who triumphed over RobinHood in the early rounds. That was kind of a big upset there. And then triumphed over Merrill Edge last round, is now going to go head-to-head with the juggernaut, the Leviathan. That is Charles Schwab/TD Ameritrade. On the other side of the brackets, we have E-Trade/Morgan Stanley. They triumphed over Trading Block in the first round, and they took out Ally Invest in the last round. They're moving on to face TradeStation, who took out IB. Kind of a bit of an upset there in the first round, and then took out Fidelity. So they've had a bit of a rough road as well, but they have triumphed so far. So it's E-Trade/Morgan Stanley versus TradeStation on one half of our Final Four, Mr. Dan. The other half, we have the Titan against the little engine that could Lightspeed. Dan, do you have any inklings how our Final Four is going to shake out, sir?
Yeah, I mean, I'll tell you, Mark. I mean, Lightspeed I love and I used for a number of years. You know, that they are a little bit smaller. I mean, if it's by votes, they probably won't get the votes they deserve. TD Ameritrade, I mean, the Thinkorswim platform is the gold standard. I mean, you know, so on that side, I mean, I see TD Ameritrade winning that, really only because of size. Lightspeed's very good as well. On the other side, TradeStation for sure, so I predict the next round is going to be, the two gold standards are TD Ameritrade and TradeStation. I can't see it any other way than them being head-to-head in the final round.
Interesting. This is the first time that TradeStation's really done well in our Broker Madness tournament. In the past, I think most people kind of associated them as mostly a futures-oriented broker, but they've been working hard, I know, to try to remake themselves as options. And indeed, they even have a crypto arm over there as well. We'll see if E-Trade, I never was a big fan. I've been trying a lot more of these platforms again of late to get more of a sense, but I wasn't a huge fan. Their legacy options offering is not good, but they do have that options house offering that's folded into them now, which they term Power E-Trade. And if you're using that, it's actually pretty robust. It's kind of like a mini live ball out there, which is kind of interesting. So if you're using the Power E-Trade platform, I think you can have a pretty decent options experience. I tried clicking through on the site the other day to play around with it. The regular options change, the link was broken. So that just shows you how much value they put in the legacy E-Trade on options. But on that Power E-Trade platform, you can actually do some interesting stuff. And of course, Toss, as you mentioned, and Lightspeed, the little engine that could. They performed. Some might say they've outperformed already. So anything else is a bonus out here. Before we keep going, speaking of bonuses, Mr. P, what's been lighting up your tape over there at MTM? What are the people coming to you this week with your MTM question of the week, sir?
I get a lot of questions from our folks, and one of them is what do I think about shorting stock? And this is a question that I actually got from my favorite new student, my son, because he's been on this Wall Street Bets and all this.
Hopefully you're giving your son a nice discount rate there.
Yeah, exactly. So, there's like a lot of negativity like, oh my God, these short sellers, let's get out the pitchforks and torches. We're going to go get them, and here's the thing, like, and I do have a unique perspective on this because when I started my career in trading, I started in commodities where there's futures, where, there's certainly no moral dilemma between long and short. I mean, for use of grain futures, for example, like farmers are always long corn, so they always need to sell futures to hedge. Food processors, grain elevators, they're always short corn. They always need to buy it. So they're always buying futures. So like long or short, like never registered in my brain as having any moral consequence or anything like that. If you think it's going up, you get long. If you think it's going down, you get short. And I don't know, maybe I'm lucky to have approached this concept this way, because when you really dig down, like there's nothing bad about being a short seller. And my son kind of countered me because, he was reading a lot of the stuff that's on Wall Street Bets, and they say, oh, these short sellers are trying to drive GameStop into bankruptcy. And I said, well, how would that work? He's like, well, they could drive the stock down to zero. I was like, well, first of all, can they? Like they own real estate. Like there's probably a value that somebody could just buy the company at zero and sell off assets, and there'd be arbitrage. So it probably can't go to zero. And even if it did, he's like, well, and what about all their employees? That'd be terrible. I said, well, the employees get paid if the company makes money. The company brings in revenue and they pay their employees. So what the stock price doesn't really matter. And so it is my stance, and not like an issue or anything, but just knowing what I know about economics and such. Like, there's nothing wrong with being a short seller. There's nothing wrong with buying puts, especially as a hedger.
Yeah, you and I came up obviously with a fairly unique way into this business, the market making route, which we were trained very early to buy and sell positions. It was just a routine function of the marketplace. And that is still how I view short sellers. I know it has been wrapped of late in this veneer of this, this moral repugnancy around short selling. People have to be long a stock in order to, to be doing your moral duty to whatever it is. That never really made any sense to me. I think I understand, though, why some people take issue with short sellers, because many of them, let's say, don't act in the most responsible of ways. They will go out there and try to manipulate a stock. Sometimes they'll leak false information to try to crush it. So that certainly has undercut their position as, market bastions of integrity. And also look at the guy who kind of set off the whole GameStop furor, putting out the webinar about how I know more than you. And they kind of act in that way that is off-putting to a lot of people out there. It's kind of the analogy I like to use. You ever played craps at the casino, listeners? Most people are playing the pass line. Everybody hates the don't pass guy because he's kind of betting against you. And so it's a similar analogy for the short sellers out there. You don't have to like them, but at the end of the day, they do perform a necessary function. They are out there sniffing around these firms, and they are uncovering fraud. They've done it again recently that other people aren't uncovering. So I'm not saying they're all angels or even nice people, but the function as a whole has a core responsible use case in the stock market. Whether all of them carry themselves that way, that's probably another debate we can have. And most of them probably don't. They probably fall short of that metric out there. They may be rubbing in people's faces a little bit too much out there, but still, at the end of the day, if you don't have short sellers, listeners, that's a very, very broken marketplace you're living in. So wipe away these moral equivalencies you have in your mind about short selling being evil and buying stocks being patriotic and American and morally just. And just look at it from an economic perspective, because that's the end of the day what we're talking about here. And that's how you have to view these investments. All right, next up, let's wrap it up with these. Dan, we got our regular listener, J3 Dingle, sending in some thoughts. I was just talking about our Final Four Battle Royale here, our mega options broker madness tournament. He's been voting, obviously, and he's chiming in. He sent in a joke about Robinhood that he says is in bad taste. I agree. So I'll spare you from reading it, J3 Dinkle, on the air, even though it is kind of funny. But then his number two, he chimed in about Robinhood. He's kind of kicking Robinhood when they're down there after getting beat in our first round. He says his favorite feature, this is one of the things we ask you, by the way, if you participate in our tournament, listeners, we added some extra bonus fields this year to give you a chance to sound off, to vent your spleen a little bit about your favorite broker feature on the broker that you use and your least favorite feature. Share that with us. It's interesting. You can do it anonymously. We'll let you do that there as well if you're worried about your broker taking some vengeance on you. But take advantage of our megaphone here on the platform. If you have a feature you can't stand, some guy was really upset about good till cancel orders on one of them, whatever it is that floats your boat or doesn't float your boat, hit us up. If it's interesting, we will share it with the broker and indeed with the world. And who knows, maybe you get some action on that. He said his favorite feature for Robinhood, Dan, is lining Ken Griffin's pockets. I think this commentary says a lot about why Robinhood got wiped out in the first round, sir. A lot of negative sentiments floating around about them these days. But that's kind of the other side. We're talking about short sellers, right? Kind of the old live by the sword, die by the sword thing. Robinhood, same thing. You know, they came out and cloaked themselves in this veneer of altruism, of helping the little guy. And yet everybody in the business who had watched them for a while, who has seen free brokers, quote unquote, come and go for years in the option space and the stock space, we all knew at the end of the day, margin rates were negligible. You weren't charging commissions. So at the end of the day, you had to be selling your flow. And they were very cagey about it in the early days. Then, of course, it came out that, of course, they were selling their flow and they were selling it for a hell of a lot. And people out there who kind of believed in the whole Robinhood ethos didn't really like that, Dan. And now they're kind of getting, I guess the old phrase is hoisted on their own petard, Mr. Dan.
I don't believe I have ever heard that phrase, Mark. But
what kind of nautical sailor are you, sir?
Apparently not a very good one. Yeah, well, you know, I mean, look, the thing is that like everybody who has a business starts the business to make money. Like nothing's charity. And by the way, I'm not saying this in defense, but you know, I am just saying like if somebody's giving you something for free, zero commissions, like, you know, they're making money somehow, right? So like, let's not be naive about it and think they're just giving you zero commissions and paying, you know, hundreds of millions of dollars in salaries and office space as a charity to you. You know, they're making money somewhere. It's just, how are they making money? I mean, I personally have a little bit of a contrary to popular opinion view. I've never been a fan of payment for order flow. And, you know, I know that that's definitely not a popular opinion within the members of our community, of our industry, but that's the only way you're getting zero commissions, though. I'll tell you that.
Well, I think it's a popular opinion here on the show, Mr. Dan, because I'm with you. I've never been a fan of payment for order flow. I was part of efforts back in, you know, early 2000s, 1999 even, when multiple listing first really happened. And we had demonstrable examples of how, hey, people getting paid to route orders to certain exchanges and certain crowds, it demonstrably impacted the customers negatively. And SEC didn't want to hear it then. They don't really want to hear it now. So I'm with you. I'm not a fan of it. Anything that kind of disincentivizes or really aligns the broker's incentives away from the outlook and the incentive of their customers really is not a good thing. So yeah, that's where we are. Of course, we saw titans of the VC industry, you know, lining up behind Robinhood in the early days. They obviously saw some money making in them, the Tar Hills. They weren't doing it, like you said, Dan, for altruism. So there was obviously a profit angle there. That's a danger. You cloak yourselves in that Robinhood veneer, it could come back to bite you. And it seems like it has. Of course, they are scheduled for an IPO soon, so we'll see if that's really hurting them at the end of the day or if these VC firms are laughing all the way to the bank as they exit at that IPO. We shall see. But Mr. Dan, we have to exit as well. If you're listening live, don't worry. You're going to get a double dose in your ears on this special Education Wednesday on Education Tuesday day here. If you're listening after the fact, you have to wait a week for the next episode. But before we go, Mr. P, if folks are intrigued, they want to kick the tires for themselves over there at MTM, where should they go? What should they do?
Make your way on over to markettaker.com. Market, like stock market. Taker, like take what is rightfully yours. 2 T's in a row, markettaker.com. And if you put a / and the word summit afterwards, you can learn about how to get a ridiculously low early bird discount to our online summer summit this year. So that is pretty exciting.
There you go. Check it out, markettaker.com. Put in the / summit there for a fabulous journey virtually with Mr. P and the crew over there. On behalf of Dan and indeed myself, I want to thank all of you out there for downloading, streaming, and subscribing. We'll see you back here next Education Wednesday, another episode of Options Bootcamp.
This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.